Hello friends, today in this session we will cover all about bond management. We know that when it comes to investments, stock market is a commonly known option. But we cannot deny the fact that stock market is highly risky and hence avoided by risk-averse investors. For such investors, bond market is an option. So let us begin today with understanding what are bonds. Our objective for this session will be broadly to cover basic understanding of bonds and various terms commonly used in the bond market. We will focus on understanding concept of yield and valuation of bonds. We will cover different ways of computing yield. Lastly, we will discuss various types of yields. Let us start by defining bonds. Bonds are considered as an important element of any financial plan used for investment or for growth of wealth. A bond, in a layman's term, is a loan an investor makes to a corporation, government or any other organization in exchange for interest payments over a specified term along with the repayment of principal amount as on maturity date of the bonds. That is, bonds are sometimes referred to as debt securities. Since bond issuers knows that investor is not going to lend his or her hard-earned money without compensation, the issuer of the bond, generally the borrower, enters into a legal agreement to pay the bondholder or investor interest. The bond issuer hence agrees to repay the original sum loaned at the bond's maturity date. The vast majority of bonds have a set maturity date, a specified date when the bond must be paid back at its face value is known as par value. Bonds are commonly known as fixed income securities because many pay interest based on a regular as well as predetermined interest rate, that is a coupon rate, which is set when the bond is initially issued. Similarly, the term bond market is often used interchangeably with fixed income market. Bonds are available in a wide range of variety, commonly known as treasury bill, agency bonds, corporate bonds, municipal bonds, etc. Price fluctuation in bonds is considered as the most difficult part as it includes lots of calculations. In this session, our major objective is to try and make it simple for you as much as possible. It might surprise you friends that bonds price changes on a daily basis, just like that of market security traded daily on stock exchange. It is nominal to hold bond till maturity. Please note that when one holds the bond till maturity, it guarantees the principal amount. However, it is not necessary to hold the bond till maturity. At any time, a bond can be sold in the open market at the price prevailing in the market, which is volatile otherwise. So, let us understand how the price changes, for which we need to introduce you to the concept of yield. The concept of yield is a pictorial representation of the return that one earns on a bond for the given period. The yield is calculated using various formulas, among which the simplest formula is given as yield is equal to coupon amount divided by price. When you buy a bond at par, that is at face value, yield will be equal to the interest rate you will earn over the period of time. Yield of a bond is highly dependent on price. As the price fluctuates, so does the yield. We refer to it as an interest or dividend received from a security, generally expressed yearly as a percentage based on the investment's cost, its current market value or its face value. For example, there are two stock dividends yield. If you buy a stock for Rs 300 on cost basis and its current price and annual dividend is Rs 330 and Rs 10 respectively, the cost yield will be 3.3%, that is Rs 10 divided by Rs 300, and the current yield will be 3% rupees 10 divided by rupees 330. Bonds have 4 yields. First, coupon, that is, the bond interest rate fixed at issuance. Second, current, which is the bond interest rate as a percentage of its current price. Thirdly, yield to maturity, that is, an estimate of what an investor will receive if the bond is held to its maturity date. And non-taxable municipal bonds, they are a tax equivalent yield determined by the investor's tax bracket. Valuation of bonds. Consider that we invest in a bond today at the current price of B0. The bond gives a coupon C1 in the next 1 year. Assuming that the bond could be sold after the end of 1 year from now at B1, we can calculate the return from the bond as return, which is equal to B1 minus B0 plus C1 divided by B0, which is equation 1. The equation can be rearranged to find the current price of the bond B0 as C1 plus B1 whole divided by 1 plus K, which will be our equation 2. We interpret this equation as the value of bond today in the present value of future inflows from the bond. Assuming now that the bond has 2 years of maturity, and if we buy the bond at the end of first year at B1, and if we sell the bond at the end of second year at B2 after we receive the coupon C2, we can calculate the return earned in the second year as return, which is equal to bracket B2 minus B1 bracket closed plus C2 whole divided by B1, or B1 can be equal to C2 plus B2 whole divided by 1 plus K. Substituting for the value of B1 in equation 2, we get the price of the 2-year bond today as B0, which is equal to C1 upon 1 plus K plus C1 plus B1 whole upon bracket 1 plus K whole square. Continuing this derivation for a multi-year bond, we could get the price of the bond equation as B0 is equal to C upon 1 plus K plus C upon bracket 1 plus K raised to power 2 plus C upon 1 plus K bracket raised to power cube plus so on till we get C plus Bn whole divided by bracket 1 plus K raised to power n. B0 is called the current theoretical or fair price or value of the bond. We can see that the numerator is cash flows from the bond and the denominator represents return. Therefore, we interpret the equation as the theoretical or fair price of the bond today is the present value of the promised future cash flows, that is, the interest and the maturity value. Here C represents the coupon, payments promised each period. As we learned that coupons are pre-decided as per bond prospects, and Bn represents the maturity value. Also, N indicates the number of periods till maturity, and K indicates the return or yield from the bond expected by an investor. Since we find the price of the bond today by discounting the coupons and maturity value using K as the yield, K is also sometimes called as discount rate. It has to be remembered that for an expected yield of K, an investor would find the theoretical price of the bond. However, the market may trade this bond equal to or above or below this calculated theoretical price. If the market price is more, then the bond is termed overvalued. if it is less than undervalued and if market price equals calculated theoretical price, then we say that the bond is fairly valued in the market. Friends, it is to be remembered that coupons received every year are assumed to be reinvested at a rate equal to the expected yield. Therefore, we are earning interest on interest. It is part of the compounding process, inherent in the nature of bond calculations. Different ways of computing yield. Bond yields are nothing but measure of return. Most commonly used measure is yield to maturity. But it is important to understand that different yield measurements that are used in different practices. Firstly, current yield. Current yield can be used to compare the interest income provided by a bond to the dividend income provided by a stock. This is calculated by dividing the bond's annual coupon amount by the bond's current price. Keep in mind that this yield incorporates only the income proportion of return, ignoring possible capital gains or losses. As such, this yield is most useful for investors concerned with current income only. Second, holding yield. Bond investors are not obligated to take an issuer's bond and hold it till maturity. There is an active secondary market for bonds. This means that someone could buy a 30-year bond that was issued 12 years ago and hold it for 5 years, then sell it again. In such a circumstance, the bondholder doesn't care what the yield of the 12-year bond will be until it matures 18 years later. If he holds the bond for 5 years, he only cares what yield he will earn between years 12 and 17. The bondholder should try to calculate the bond's 5-year holding period return. This can be approximated by slightly modifying the YTM formula. The bondholder can substitute the sale price for the par value and change the term to equal the length of the holding period. Hence, it is also known as holding yield bond. Thirdly, yield to maturity YTM. As mentioned earlier, yield to maturity is the most commonly used yield measurement. It measures what the return on the bond is if it is held till maturity, and all coupons are reinvested at the YTM rate. Because it is unlikely that the coupons will be reinvested at the same rate, an investor's actual return will differ slightly. Calculating YTM by hand is a lengthy procedure, so it is best to use yield mat functions for this computation. A simple function is also available on a financial calculator. Lastly, yield curve. The yield curve is a pictorial representation which plots time in ascending order on the horizontal axis and yield on the vertical axis, showing the relationship between the two. Yield curves are the best used when different maturity dates for the same type of bonds are plotted. That is, meaning that the only major difference in the securities is their maturity date. For instance, a yield curve gives a comparative picture of treasury bonds, corporate bonds with high credit rating, municipal bonds, or any other type of bond by plotting maturities and their respective yields from a particular state. By comparing such yields of bonds that are similar but differing in maturities, one can generate a graph which reflects the change in yield with respect to the maturity date. The yield curve types. There are 5 types of yield curve. Each type of yield curve has their own characteristics and is represented differently on a graph plane. We will learn briefly all these yield curves with the help of a pictorial graph. Number 1, the normal yield curve. A normal yield curve is upward sloping, showing all the yields earned at different duration of the bonds. The curve also reflects the fact that a bond with a longer maturity pays a higher yield than the same bond which matures early. The yield curve is upward sloping majority of the times, so it is also known as a normal YTM. Thus, the yield curve majorly is in the shape of a normal upward sloping curve as depicted in the picture. It will be worth noting that the individuals and institutions prefer to lend money for shorter periods of time as compared to longer periods of time. This is in general because of the fact that the risk the borrower will be unable to pay rises with the passage of time and lender needs his fund back. To be precise, the longer the term of loan or bond, the greater are chances of default on the part of the borrower due to controllable or non-controllable events. Hence, as the lender's risk increases, the interest rates of the bond climbs up as well. That is, higher the risk, greater are the returns from bonds. Second, the steep yield curve. When an investor is expecting interest rates to rise in the future, he ought to demand a higher rate of return, especially when buying longer term bonds. However, if the returns are not high, then investors would prefer safe play and will buy shorter term bonds, simply expecting that they may buy longer term bonds in next purchase when their expectations are fulfilled. Friends, we as students need to understand that bonds do underperform when the economy is going through recession. However, the investors' expectations are high when the economy seems to recover from the recession. This is because economic recoveries are normally accompanied by corporations wanting to borrow more for investments, which increases the demand for money, putting an upward pressure on interest rates, or what we know as demand pull inflation. This results in the yield curve steepening as it is observed in the graph. Third, the flat yield curve. As the name suggests, the flat yield curve is horizontal. It basically represents that yields of all maturities are close to one another. This is because when the inflation expectations have decreased to a point where investors find no time value for money, even if they hold the bond for longer period of time. Like in the case of inverted yield curve, when the yield curve moves from normal to flat, this is generally a sign of pending or ongoing economic slowdown. The humped yield curve. We can observe a hump in yield curve when short and long term rates are closer to each other as compared with medium term rates. It is commonly seen when there is fluctuation observed, that is, increase in demand or decrease in supply of long term bonds. Say for example, a 30-year treasury bonds is always more preferable than a 20-year treasury bond, resulting in a humped yield curve for treasuries. Lastly, the inverted yield curve. Friends, the inverted yield curve demonstrates that the long-term interest rates are lower than short-term interest rates. However, this phenomenon rarely occurs, but when it does, it is one of the surest measurement of an economic slowdown. An investor anticipates less future demand for money and therefore lower interest rates. So friends, let us recall whatever we have learned today. Today we learned in detail about commonly used terms in the bond market like par value, coupon rate, etc. We learned about an important concept of yield. We observed how different interest rates and maturity dates affect the yield curve with the help of graphs. We also learned about computation of yield of bond with 3 different methods. Hope you enjoyed the session. Thank you.